In this video, we're going to be covering a stock that I believe has 30% upside, and it's definitely an unusual name for me to cover. It's 1-800-FLWS.com, ticker symbol FLWS. And you're probably thinking, why is this guy talking about a company that is delivering flowers? That's not hot, that's not snazzy. Talk about AI or something like that. Well, it turns out that this company is profitable. It's been beaten down a little bit over the past month or so. And when I look at the business itself and actually how many brands it owns, overall, I believe it does have 30% upside. And in this video, I'll talk about all the reasons I believe that. If you take a look at the stock, it's currently at $24.84, and year to date started in the high 20s and got to a peak of around $37. Now, just because it's fallen back from that 37 level doesn't mean it's a buy. Let's talk about what exactly this company does, and then as well as some of their competitors. If we take a look at all the different brands that they own, it's just not a flowers company. As I said, they're in gift baskets, baked goods, chocolate covered strawberries, you name it. And some of those brands include Harry & David, Personalization Mall, Sherry's Berries, Popcorn Factory, and as you can see, there's a total of 15 brands that the company owns. Basically, the entire purpose of the company is to allow customers to connect with friends and family. When you look to see who are the competitors of 1-800-Flowers, you can see that Kirkland's and Michael's are public companies, but realistically, those companies are more focused on decor and home goods compared to 1-800-Flowers.com, which is mostly e-commerce and about gift giving as well as flower delivery. So in my opinion, we're off to a great start, because if there's not a direct competition, that doesn't mean that they're sharing market share with any other companies, and it's a niche market where you don't have huge companies having interest, because who's trying to get into the flower business or the business of giving fruit baskets? Now let's talk about my favorite part of the company, which is the financials. If you look at the trailing 12 months PE ratio of 15.9 and then take the expected EPS growth rate for the next 5 years of 20%, divide 15.9 by that 20, and you get a PEG ratio of 0.795. Now, if you're not familiar with the PEG ratio, it's one of my favorite financial metrics, and it was created by Peter Lynch, a legendary investor who beat the markets for years on end. Anyway, for anything under 1, it's considered a good value. And the main reason the PEG ratio is important and it's helpful is that it gives context to the PE ratio, because if you have a high PE ratio but high growth rate expected for the earnings, then that high PE ratio can be okay. Whereas if you have a low PE ratio where people think, oh, it's a great buy, but if the growth rate is terrible or negative, then it could be a value trap. Of course, you can't just look at a metric and blindly invest. We also have to look at the financials for the latest quarter results, as well as looking at the trailing 12 months and how the company's been doing and kind of what the trend is. So if you look at the last quarter, the net revenues were up 44.8%, which is great, as well as the net income being up 53%, which is even better. Now, if you're looking at that net income number of $113 million and thinking, oh my God, why is this thing only worth $1.6 billion, when if they do that every quarter, that's a crazy amount of net income for the current value of the company. Well, you have to realize that this company is very seasonal, meaning that the last quarter of the year is basically when they make all of their money. So just a lesson when you're looking at stocks, is it seasonal? Is it a company that makes the same amount every quarter no matter what? For this company, most of their profits come in that last quarter, and actually the 3 quarters leading up to it, usually they're flat or actually negative when it comes to earnings. And we can see that play out if you look at the income statement on a quarterly basis. The net income in that last quarter, 113, but you can see the previous 3 quarters, it's either flat or slightly negative, right? So it's all about that last quarter for this company when it comes to net income, because $877 million of revenue comes in the last quarter versus $278 in that first quarter. One of the main reasons I think the stock is coming back or pulling back is because of COVID. Now, obviously, this company has benefited from COVID and the momentum in e-commerce, or people giving gifts online versus in person. What I believe, though, is that customers won't instantly just disappear off the platform and never use any of the avenues or brands that 1-800-Flowers.com has. I think there'll be some retention of those customers, and if that happens, or even if revenues shrink slightly, this company is still valued higher in my opinion. And a huge reason I don't believe revenue will go back to pre-COVID levels is because they actually bought a new brand in 2020. They bought Personalization Mall from Bed Bath & Beyond. The reason I really like this acquisition is because the company basically took a period where Bed Bath & Beyond was trying to raise cash. They bought this business, and now they have future increases in revenue, meaning more profits down the line, and they did it in times where their company was very profitable. They used that cash to fuel growth in the future. And you can see it show up in the cash flow statement here where they're buying a business for $252 million. And even with that, it's also important to note on the cash flow statement, they generated free cash flow of $254 million, which is great for a business of their size. In terms of a discounted cash flow model, I use these assumptions up here, as well as Q1, we got some insight into the revenue projections, which basically comes out to a 9.2% increase for the whole year, if they have an increase of 50% in Q1. Some other assumptions that were used, we looked at the trailing 12 months as the base for revenue and assumed an 8% increase in revenue for year 1, 3% in the next year, and then actually negative growth after that, keeping the same margins. So no operational efficiency improvements over the years. That would make the shares worth $33.06 per share. Now, if we took out any growth in revenue and just made it flat, it'd be $30.94. And then if we actually factored in some operational efficiency, improving 10 basis points per year, you get $34.88. Now, if let's say the revenue just fell off a cliff and it was actually minus 15%, and they kind of go back to revenue in prior years, the company would be worth around $26.48. So, in my opinion, even if the revenue just falls off a cliff and actually goes back to prior periods, the company is still fairly valued. To sum things up, we basically have a stock that there's fears around COVID retraction in terms of revenue, but they did buy a company for cash to fuel growth in the future. Also, we have a company that's trading at a reasonable ratio in terms of PE ratio, and they're expected to grow their earnings over the coming years. So with all that said, I basically believe the company could be 30% higher than where it's at right now. Of course, that's my opinion. If any of those assumptions change, the valuation of the company would change. But if you did enjoy the way I went through the stock, kind of valued it, went through my assumptions, give this video a thumbs up. It helps the algorithm, as well as consider subscribing to Main Street Wolf, where I'll continue to talk about stocks, options, investing, all that fun stuff. Thanks guys for watching, and have a great day.